So you want to own a prison, not run one for a paycheck. Own one outright. The building, the contracts, the beds, the whole machine. On paper, it sounds like the cleanest business in America. The government promises to pay you every single day, whether or not the economy is good, whether or not anyone likes you. Guaranteed customers forever. Sounds simple, almost too simple. It is not simple. Let's start with what it actually truly costs to get in the door. Because buy a prison is not one single price point. It's a ladder, and where you land on it changes everything downstream. At the bottom of the ladder, you're not really buying a prison at all. You're buying a contract to operate one that already exists, usually one the state built decades ago and no longer wants to run itself. You put up almost no capital. You just win the bid, staff the place, and start collecting per-day payments. Cheap to enter, thin margins, and you're fully at the mercy of whatever rate the state sets. Near the top of the ladder is what CoreCivic did in Lake Erie, Ohio. In 2020, the company paid $72.7 million to buy the Lake Erie Correctional Institution outright, land, buildings, and every structure on the property, from the state of Ohio itself. That's a real number on a real balance sheet for one facility. In exchange, the state signed a contract running through 2032, agreeing to send them prisoners and pay for every one of them, every day, for over a decade. That's the tier difference. Bid on a contract and you're a tenant, subject to eviction at the next rebid. Buy the facility and you're a landlord with a captive, government-backed tenant of your own. The second one costs vastly more upfront, no question about it. It also locks in cash flow for 12 years, which is the kind of certainty most businesses would kill for. There's a third tier too, sitting between those two, the distressed acquisition. This is buying a facility that's already troubled. Maybe it lost a state contract. Maybe a lawsuit scared off its previous operator. Maybe it's simply been sitting half-empty for years. You get it cheap, sometimes for a fraction of what it cost to build, but you're inheriting someone else's reputation problem along with the concrete. Turning a distressed facility around means rebuilding trust with a state government that's already been burned once, and that is a slower, more expensive process than anything reflected in the purchase price. Either way you enter, you're about to learn a vocabulary that sounds bureaucratic and boring right up until you realize it's the entire business model. The first term is the per diem rate. This is the daily rate the government pays you for every person in your custody. Think of it as your room rate, except your only guest is the state, and the state negotiated hard. At Lake Erie, CoreCivic's per diem from the Ohio Department of Rehabilitation and Corrections sits at $48.51 per inmate per day. Multiply that per diem rate by a full facility and you start to see the shape of the revenue. The second term is the guaranteed minimum. And this is the clause that actually makes the whole thing investable. The state doesn't just pay per diem on however many people happen to be locked up that week. It guarantees you a minimum occupancy. In Lake Erie's case, 95% of the facility's capacity, whether the beds are actually full or not. That guarantee is worth more than $78,000 a day at that single site, over $28.5 million a year, paid essentially no matter what. Layer on top of that an ownership fee. Ohio separately pays CoreCivic $3.8 million a year just to recoup the cost of having sold them the building in the first place. Contracts like this run for pages, sometimes over 100 of them, but the whole engine, once you strip away the legal language, reduces to those few numbers: a daily rate, a guaranteed floor, and a long horizon. There are two more pieces of the legal structure worth knowing, because they decide whether you keep the contract at all. The first is accreditation, a third-party review process, usually run by an industry association, that certifies your facility meets basic staffing and safety standards. States lean on that accreditation instead of doing the inspecting themselves. So losing it doesn't just look bad, it can trigger an automatic default clause in the contract. The second is the rebid cycle. Every few years, the state reopens the contract to competitors, and your incumbent advantage is real but not permanent. Performance problems are exactly what a rival operator's lawyers will hand to state lawmakers at rebid time. Here's the first thing nobody tells you before you sign. The guaranteed minimum is a double-edged sword. It protects your downside when population drops, but it also means your revenue barely moves whether you're running a calm, well-staffed facility or a chaotic, understaffed one. So the financial pressure always points toward doing less, not more, and that pressure shows up as real cost fast. Staffing is the single biggest expense in this business, and it is also the least stable. Turnover at private facilities regularly runs past 100% a year, meaning the average guard doesn't last 12 months before quitting. Every departure means recruiting, background checks, and training a replacement, over and over, on a payroll that's often the largest line item you have. Understaffed shifts also mean mandatory overtime for whoever's left, which burns out the staff you do manage to keep, feeding the same cycle right back into next quarter's turnover numbers. Then there's the legal exposure, and this is the one that blindsides new owners hardest. In the years after CoreCivic took over Lake Erie, inmate-on-inmate violence rose by roughly 180%, and inmate-on-staff violence by around 300%. Violence like that doesn't stay contained to a headline. It turns into lawsuits, into settlements, into state monitors showing up unannounced, into renegotiated contracts with tighter performance clauses attached. You bought a fixed revenue asset. You did not buy a fixed cost one. Add to that maintenance on an aging building you now own outright, insurance that gets more expensive every time a facility makes the news, and compliance staff whose entire job is responding to audits, and the guaranteed business starts to look a lot more like the same operating grind as any other, just with a government logo attached to the invoice. There's also a slower moving cost that rarely shows up in year one projections. Settlements, wrongful death suits, injury claims, and civil rights litigation against private operators routinely resolve for sums in the millions of dollars each. And unlike a per diem rate, a jury verdict isn't something you can renegotiate down. Owners who model this business off a clean spreadsheet of daily rates times bed counts are almost always missing this line, and it's often the line that decides whether a given year was actually profitable. So where does the money actually come from once the doors are open? The core is still that state per diem contract, the daily rate times the guaranteed population, arriving like clockwork, month after month, regardless of headlines. But the real upside in this industry over the last few years hasn't come from state prisons at all. It's come from federal immigration detention. When Congress passed a major funding package in 2025 that allocated $45 billion for immigration detention through 2029, companies like CoreCivic reactivated facilities that had sat empty for over a decade. One Oklahoma site, idle since 2010, is projected to bring in $100 million, once fully operational, from a building that was producing zero revenue a year earlier. In just the third quarter of 2025 alone, CoreCivic reported $580 million in revenue, up 18% year over year, largely on the strength of those new federal contracts. Beyond the two big per diem streams, state and federal, there's a layer of smaller revenue that adds up. Commissary sales marked up inside the facility, phone and video call fees charged to families trying to stay in touch, transportation contracts moving detainees between sites, and in some states, inmate labor contracted out to third parties at wages that make the margin almost entirely yours. None of these individually rival the per diem contracts, but together they can add several percentage points to your operating margin. And unlike the government rate, you control the pricing on almost all of them yourself. So let's actually run the numbers on owning something like Lake Erie. In the optimistic scenario, occupancy sits comfortably above the guaranteed minimum, so you're being paid for real, full beds rather than just the floor. Violence stays low, turnover stays manageable. The state renews your contract early because nobody wants the headache of finding a replacement operator, and federal detention demand stays elevated, letting you bid your other properties into that same $45 billion pipeline. Accreditation renews without incident, no major settlement lands, and the ownership fee keeps flowing on top of the per diem. Under those conditions, a facility like this can run operating margins in the mid-20s%. Real, durable, almost annuity-like income for the life of the contract, the kind of cash flow that private equity firms specifically hunt for. In the realistic bad year scenario, a lawsuit lands from a violence-related incident, forcing a settlement and a court-ordered staffing increase you didn't budget for. Turnover spikes past its already brutal baseline, so you're paying overtime and recruiting bonuses just to keep the doors legally staffed. A state audit finds understaffing violations, triggering a penalty clause buried on page 90 of the contract, shaving points directly off your per diem, and putting your accreditation itself under review. Local advocacy groups, media coverage, and a change in the state's political leadership put your contract renewal in genuine doubt. 3 years before it's even up, and a rival operator quietly starts courting the same legislators you thought were locked in. Your guaranteed minimum still protects the revenue floor, but the margin between that floor and your ballooning costs gets thin fast, and the 12-year horizon you priced in at purchase suddenly feels a lot less guaranteed. That's the honest picture of this asset. It looks from the outside like the ultimate recession-proof business, a customer that's contractually obligated to keep sending you people and money for over a decade. And in the numbers, it often is exactly that. Wall Street treats companies like this less like prison operators and more like real estate investment trusts with a captive tenant, which is precisely why the acquisition price at the top of the ladder gets paid at all. But what you're really buying isn't a building or a bed count. You're buying a piece of the machinery that decides what happens to people who have nowhere else to be sent. And every dollar of profit in that machine is inseparable from a policy decision made by someone else, in some other room, that you don't control and can't predict. Own the prison. And you don't just own the real estate, you own the incentive.